Hello everyone. Uh, my name is Professor Bandari, and before I move to our main topic today's, I'd like to thanks everyone, and I'm a chief editor of CurrencyHacked.com. And in today's video, I'm going to talk about the how we can how to beat the 90% above money manager. If you don't know about them, money manager are managing the money of the public, and they are claiming that they will give them a return. Or they will give them a return on their money. Let's say if they take 100,000 and then they promise to the public they will give you the return more than the index fund. And in the past, if you see in the past, and if we examine the past, for few decades, we found and the some other popular, even some other popular investor also have told us that they did not able to beat the index fund, as well as that they did not do whatever they promised to the public. So in today's video, I am going to talk about the how you might be able to beat the 90% or above money manager, which they are which you might want to hire them. And it's really simple, and it is really easy, even you can do by yourself. Because let's say if you have some money in your bank account, let's say $1 million. If this money are doing nothing for you, even if you put in the bank, they will pay you probably 2 to 3% of the interest, which will offset by the inflation. I don't know in which country are you living at the moment. You might be living in the Nepal, or maybe India, or US. Even if we take the US, then there is a inflation between 2 to 3% in the past few decades. So we can expect that the inflation will continue 2 to 3%, or maybe 2 to 4%. So that it's really important that you gain your purchase power of the money, as well as that you get the good return in your money. Because in the final, you have to exchange your money for something. Let's say if you want to buy a rice, then you have to exchange it your money for the rice as well. So the better idea is to invest in the good company, or maybe in the good stock. But the question is how you can find the good company, or maybe how you can find the good good fund to invest. So the our question our answer to this question will be the index fund. Because if you don't know about Warren Buffett, even Warren Buffett is the most popular investor on all time. And he also told us in his 2020 annual meeting that he can't guarantee his company will return more than the index fund. Because he also believe in the index fund, and he believed that index fund will generate the 8% compounded return, which included the dividend on it. So the better bit is the undoubtedly the index fund. So that if you can generate the 8% compounded return in the long run. Let's say we are not talking about the 1 years or maybe 2 years. We are talking about the 10 years, 20 years, or more, maybe more than that, 30 years, let's say 40 years. Because we know that the investment will do far better in the long run than the short term. Say for example, if you found the good company, we believe that the long term prospect will be the far better than the short term prospect. Because the even it's going to take some time to finish some project, and the research the project, and the everything. So to beat the 90% above money manager, all you have to do is you can look for the index fund. If you don't know about the index fund, let me go to the Google over here. And before I go to the index fund, and I'll show you index fund, don't forget to subscribe into our channel currencyhacked.com. because in CurrencyHacked.com we've been keeping our reader and the viewer about the education related to the finance, business, and the investment, which will help our viewer and the reader to take a better decision in their investment. We are really focusing on the long term investment, but you can get a pretty much good idea about the investment in our channel, and we've been working on that. So let me go to the Google over here and type the index fund, INDEX index fund, say, and then it will. So if you don't know about the index fund, let me go to the Investopedia, or can go to the Investopedia. Investopedia is of course undoubtedly the better place to learn about the investment. What is index fund? Let me read it forward. An index fund is a type of mutual fund of or exchange fund, ETF, we call it ETF, with a portfolio constructed to match or track the components of financial market index such as the Standard and Poor, S&P. And an index mutual fund is said to be provide broad market exposure, low operating expenses, and low portfolio turnover. It means that you need to pay the low operating expenses, mean you need to pay low fee to buy the index fund, and the it has a good low portfolio turnover as well. So let me show you the S&P return. S&P return in past 20 years, and indeed it says that we get the forwards, and it says that indeed for most of the 1990s and the last decade, the 20 years S&P 500 return was over 8%, and for a while it was way over that level. But today investment climate is different. We are 9 years in bull market for this reverse index, and even that has only lifted a 20 years return 4.5%. And we can go to the Investopedia as well. And it says that the average annual return since adopting 500 stake into the index 1957 through 2000 is roughly 8%. So whoever invested in the S&P, and we called it S&P Standard and Poor is the index fund, and they have been generating the 8% annually, and because we know that the market can go up and sometime down, but in the long run it will and the one things that you have to understand is the market stock is the weighing machine in the long run, and in the short term it is the voting machine. So the return will be great if you are going to invest in the long run, say 20 years or 30 years. So, and for this you don't have to pay the high expenses, high fees, and anything in to the broker, or say the say the index fund, or anything like exchange fund. So and the John Bogle on starting or first, John Bogle is started the first index fund, and he's pretty smart person. So if you want to learn more about the index fund, you can go to the Google and type the index fund. Here I'm trying to give you some summary idea about it, and what you can do to work your money for you. So let me go to my slide over here, and this way you can buy the index fund. If you want to buy an index fund, there are a lots of broker, say Vanguard. If you are in US, I'm not really actually don't know about the US. I mean US the US the broker, but I believe that the Vanguard and some other broker that you found to buy the index fund, and we recommend to buy an index fund if you don't have a much time to to analyze the market, or maybe to resource the individual stock. Basically you are holding the 500 top company that they are in the America. So that way you can beat the 90% or above money manager in the long run. So let's move to the another topic. I'm going to talk about the how we can make the profit from the common stock, because this can be very interesting. And the if we have been talking about the temptation, because temptation, we have been seeing the nature of the human in the past few decades rather than the actually history of the price. Because people are panicking sometime, and people are was depressed, and when public was depressed in that time, we got the stock in the very low price. And when people are in a prosperous time, the stock price were overpriced. So if we want to make lots of profit from the common stock, undoubtedly the past shows that the buying in times of depression, say in the 2007 or 2008, or maybe find a common stock below the intrinsic value, which you can find through the fact data, such as dividend earning assist behind the company, and some other fact data which will help you the intrinsic value. But remember that the intrinsic value is not a exact value like the price of the, let's say, book. If someone says $100 in the book, it will be the intrinsic value of the $100 of the book. But in the common stock, let's say if you find out some value, probably the around the $100 of the common stock, then you might want to buy them on $30, on $40, or you might want to sell them on $200, because you know that the intrinsic value of the common stock is around $100. And then you know that if the stock is go to the 200, then you will know that the the common stock is overpriced. And when the price of a common stock was down by the down to the same common stock down to the $40, you will know that the the intrinsic the common stock was selling far below the intrinsic value, and then in that time you can buy it. So that's it for today. If you have any feedback, or if you want to contact us, you can always send us email at info@currencyhacked.com. Or if you want to contact me personally, you can always send me a email at seeba@currencyhacked.com. Thank you for watching our video here in currencyhacked.com.